Okay, let's dig into this. We're doing a deep dive today on, well, something that affects all of us, right? Our relationship with money.
Mm.
But not the typical spreadsheets and, market analysis side. We're talking about the psychology, the human element.
Yeah, the messy part. Our source material for this is a really thorough analysis of Morgan Housel's book, The Psychology of Money. It's fantastic stuff.
It really is. And that core idea, the one our source really pulls out from Housel, is that finance often kind of misses the mark.
Right. It assumes we're all perfectly rational robots making logical decisions.
Which we're definitely not.
Yeah.
Housel argues, and the analysis supports this, that financial success often boils down more to, like, your behavior, how you handle yourself, not just pure intelligence or data crunching.
Exactly. It's about those habits you build, how you react when things get stressful, your emotions around money.
So our mission today is basically to pull out the key takeaways from this analysis.
Yeah.
Help you understand why your own money situation feels so personal, maybe even confusing sometimes.
And often pretty surprising, yeah.
Let's start with that core idea then, that behavior is the foundation. Housel has this great line, no one is crazy.
That one really resonates, doesn't it? Because, you look at some decisions people make with money and think, what are they doing? That's totally irrational.
From your perspective,
Yeah.
based on your life.
But House's point is, from their perspective, given their unique background, their history, the economy they grew up in, it actually makes perfect sense to them.
What looks illogical to us is completely logical based on their own lived reality.
Yeah. Like the examples in our source, someone who lived through the Depression saw banks collapse. Maybe they hoard cash. They don't trust stocks.
And to someone younger who's only seen markets generally go up, that seems overly fearful, maybe even counterproductive.
Exactly. Or think about someone whose family finances were chaotic versus someone who had total stability. Their baseline comfort with risk is just fundamentally different.
And these experiences, even if they're just a tiny, tiny fraction of overall financial history, they really wire our brains, don't they? They shape how we see risk, how we see opportunity.
Totally. It's a psychological reality, which means, there isn't one single right financial plan for everyone.
Right. The textbooks might show an optimal strategy, but if it doesn't fit your psychology, your history,
You won't stick with it, especially not when things get tough. So finding the plan that fits you, that you can actually live with, is way more important than finding the theoretically best one.
Yeah, absolutely.
Yeah.
And speaking of things we can't fully control, that leads us nicely into Housel's points about luck and risk. Huge factors, often underestimated.
Oh, massively. It really pushes back against that myth of the self-made billionaire who did it all through sheer genius. Skill matters, effort matters, obviously.
Of course.
But luck. It's often a much bigger piece of the puzzle than we like to admit. Our source highlights the Bill Gates example.
Right.
Brilliant guy, incredibly driven, no question. But having access to that super rare, expensive computer back in high school, that was, well, a huge stroke of luck. Gave him a massive head start.
That's such a great illustration. And thinking about it that way, it changes how you see success and failure, doesn't it?
Totally. You're less likely to get massively overconfident when things go well. It was all me.
Right. And maybe less likely to beat yourself up when things go wrong, recognizing that risk is just inherent. Some things are out of your hands.
And that feeds directly into strategy. If luck plays a role, your plan needs to be robust enough to handle bad luck. The unexpected stuff.
Like a recession, or getting sick, or losing a job.
Exactly. It means you need some conservatism baked in, even if you're aiming for growth. You need to be able to survive the downturns.
And it makes looking back at past performance really difficult. The analysis points out that so much historical success, especially in investing, has a huge luck component.
Yeah. So just assuming what worked before will work again, that's a dangerous assumption. You're basically betting lightning strikes twice.
Okay, here's another one that sort of flips conventional thinking. The book argues, and the analysis really digs into this, that your saving rate is often more important for building wealth than your actual income level.
This one surprises people, right? We're so focused on earn more, earn more.
Totally.
But the data Housel looks at, and our source confirms, consistently shows people with, say, moderate incomes but really high savings rates often end up wealthier than high earners who save very little.
It just makes sense mathematically when you stop and think. Wealth isn't just what comes in, it's what you keep and compound.
The big enemy here is lifestyle inflation. That's the psychological trap.
Oh, yeah. Get a raise, buy a fancier car, income goes up, spending goes up right alongside it.
You're working harder, earning more, but not actually getting further ahead in terms of building wealth.
So the people who really succeed often manage to keep their spending relatively steady, even as their income climbs. That gap between earning and spending, that's the engine.
That's where wealth is built. And the benefits of saving aren't just numbers on a page. The source highlights this too. Saving gives you options.
Flexibility.
Resilience.
Exactly. It's a safety net.
Uh-huh.
It buys you peace of mind, reduces stress, reduces your dependency on any one job.
And that feeling of security, it lets you make better decisions, doesn't it? You can choose paths based on what's interesting or fulfilling, not just what pays the bills right now.
Which connects perfectly to another really critical idea for, well, not just success, but avoiding disaster, defining enough.
This sounds so simple, but it's incredibly powerful. Housel suggests that not knowing what's enough for you is one of the fastest routes to making terrible mistakes.
Because the goalposts just keep moving, right? You hit one target, and immediately you're chasing the next bigger one. There's no satisfaction.
And that endless chase for more can make you do incredibly risky things with the wealth you've already built.
Our source analysis brings up those examples like Rajat Gupta and Bernie Madoff, guys who had so much money, unimaginable wealth.
Yeah, and they threw it all away, risked everything because they were still chasing just more. It's a cautionary tale.
The core lesson being, don't risk something you have and need for something you don't have and don't need.
So defining enough isn't about lowering your ambitions. It's about figuring out what level of security, what kind of lifestyle actually brings you genuine satisfaction.
And then focusing on achieving and sustaining that. It's like setting a finish line. Okay, I've reached a level of comfort and security. Now the game shifts.
From accumulation to preservation. And crucially, Housel points out that staying wealthy takes different skills than getting wealthy. Getting rich might involve big risks, optimism.
Sure.
Staying rich requires more humility, maybe a bit of fear, even paranoia about what could go wrong. You need both skill sets at different times. Ignoring that is dangerous.
Okay, let's shift gears slightly. Compound returns. Housel talks about this as like the slow, steady, reliable path.
Yeah.
But it needs patience.
Yeah, the magic of compounding is that it's exponential, not linear. Its real power shows up over long stretches of time. Small gains early on can become massive amounts decades later.
And the research consistently shows, doesn't it, that success here isn't really about genius market timing. Try and pick the absolute bottom or top.
Not usually, no. It's much more about time in the market, just being invested consistently over the long haul.
The analysis mentions that a huge chunk of the wealth created by compounding actually happens in the later years, year 25, year 30. The growth then can dwarf the first decade.
Which is the best argument ever for starting early if you can and just staying put, staying invested through the ups and downs.
And a practical way to do this, as the source points out, is often just consistent investing in broad, low-cost index funds.
Right. You're not trying to be a stock-picking genius. You're just capturing the market's overall growth, reinvesting dividends, keeping costs low. Remove the temptation to fiddle.
But the key, the absolute linchpin, is sticking with it. Can you keep investing when markets are tanking? Can you resist cashing out when they're soaring? That's the hard part.
That's the psychology again, which brings us to what mindset you need for long-term investing and managing risk effectively. You have to get comfortable with volatility.
Yeah, those short-term swings are the price of admission for long-term growth.
Yeah, exactly. Compounding needs time to work its magic, and that means leaving the money alone, letting it ride out the bumps. Housel observes that people who check their portfolios constantly react emotionally.
They tend to do worse.
Yeah, they often underperform those who take a more patient, maybe even slightly hands-off, set it and forget it approach.
There's that interesting concept too, tails you win.
Yeah. The idea that often in a diversified portfolio, your overall success isn't driven by everything doing okay. It's driven by a few huge winners, the long tail investing.
Then outliers.
Right. And you don't know beforehand which ones they'll be, which is another strong argument for diversification. You spread your bets partly to catch those potential huge winners.
It's also crucial, the source stresses, to match your risk level to your time horizon. Money you need soon shouldn't be risked.
Absolutely. 5-year money versus 30-year retirement money. Totally different risk profiles needed. Getting that wrong is a common way people get hurt.
And risk management isn't just math, is it? It's psychological prep.
Big time. Our source emphasizes accepting before it happens that you will have losses sometimes. Markets go down. Investments lose value. It's normal.
If you accept that mentally up front, you're less likely to panic and sell at the absolute worst time when it actually happens.
You see it as part of the process. And Housel extends this idea beyond just stocks avoiding single points of failure in your life generally.
Like being too reliant on one job, one industry.
One location, even one currency. Diversifying your life provides a buffer.
Which brings us to maybe the most important risk management tool, margins of safety.
Yes, this is about building buffers everywhere, having cash reserves, avoiding too much debt or leverage, keeping your overall risk exposure manageable.
So that if something bad does happen, even something big, it doesn't wipe you out. It doesn't force you into a desperate decision.
Exactly. It's about survival first. You might not maximize every last potential dollar of return with a margin of safety.
But you dramatically increase your odds of staying in the game long enough to get any meaningful returns at all. Survival is key.
Which leads beautifully to maybe Housel's most profound insight, the one our source really elevates. Redefining wealth itself. True wealth isn't status, it's freedom.
That's a powerful reframe. We're so conditioned to see wealth as, the flashy car, the huge house, visible consumption.
That's status. Housel argues true wealth is invisible. It's the financial assets you don't spend, the assets that give you options, control over your time, flexibility.
And ironically, chasing status by buying expensive stuff often destroys wealth because you're spending down those assets. He has that great man in the car paradox.
Oh yeah, that's brilliant. You buy the Ferrari hoping people will look at you and admire your success.
Right.
But what actually happens, Housel points out, is people look at the Ferrari and think, wow, if I had that car, people would think I was cool. They admire the car, not you. They project themselves onto it.
And the research really backs this up, doesn't it? Experiences and autonomy control over your time bring much more lasting happiness than just buying more stuff.
Definitely. So true wealth isn't about accumulating possessions. It's about accumulating security and options. The ability to say no to things, to pursue opportunities without financial pressure, to weather storms.
The ultimate luxury, Housel suggests, is waking up and knowing you can control your day, that you have autonomy.
Yeah, framing your financial goals around buying time freedom. That changes everything. It aligns your finances with what actually makes humans happy.
Financial independence lets you make choices about work, about life, based on what actually fulfills you, not just pure necessity.
Which often leads to better long-term outcomes anyway, because you're playing a game you actually want to play.
So the practical application is, figure out what enough looks like for you in terms of freedom and lifestyle. Work towards that number. Then maybe shift focus from just earning more to actually living more.
And tying it all together, the whole framework Housel builds, emphasized by our source, is about finding sustainable behaviors, things you can actually do consistently for decades.
Not some hyper-optimized, complex strategy that you'll ditch the first time things get scary.
Exactly. This is where things like automation really help. Setting up automatic savings transfers, automatic investment.
Takes the daily decision-making, the emotion out of it.
Right. It helps you stick to the plan during stress. A good enough plan that you actually follow consistently is far better than a theoretically perfect plan you abandon.
Keeps coming back to that, doesn't it? Behavior over brilliance. Sustainability over optimization.
It's about understanding yourself, managing your emotions, saving consistently, thinking long-term. These are skills anyone can develop.
Which is really hopeful, I think. Financial well-being isn't some secret code only geniuses can crack.
Not at all. It's accessible through discipline and the right mindset.
So to wrap up, the core message is really about mastering your own psychology around money, defining what enough means for you, diversifying sensibly, always keeping a margin of safety, understanding luck and risk, saving consistently, and ultimately aiming for time freedom, not just status symbols.
These aren't just financial tactics. They're almost life principles that use money as a tool to build a better, more secure, more autonomous life.
So maybe a final thought for everyone listening, something to mull over. Now that you're thinking more about your own money psychology, your own history and biases, how might that awareness change the very next financial decision you make, big or small?